Well, for more on today's economic reports, we're joined now by another Mike, Michael Englund, one of our Bloomberg best. That means he's one of the most accurate forecasters in the world. Mike is chief economist at Action Economics. He was on the board of the directors for the National Association of Business Economics. He's joining us from Denver this afternoon. So, Mike, thanks a lot for joining us. And obviously, we just got the rundown on the data from our Michael McKee. As you looked across the spectrum today, what did you find the most disappointing of the many data points that we got out?
Well, I think Mike pretty much hit the nail on the head. The Empire State Index was really a shot across the bow, and the Philly Fed numbers reinforced it. Essentially, the U.S. data has been very dynamic the last couple of weeks, and unfortunately, most of the dynamism are downside surprises that are larger than usual. Whole string of them over the last couple of weeks, and particularly over the last couple of days. Most economists, just for this last month of the second quarter, a lot of this data is for June, have knocked their GDP numbers from 3% down to 2%. When we got these two factory sentiment surveys for July, it suggests that the confidence in the factory sector is continuing to fall pretty abruptly. The employment indices were quite weak, which suggests that the next non-farm payroll report for the month is going to be ugly. So this bad news for June looks like it's carrying on into July.
Hey, Mike, you know, we get sort of bogged down in these day-to-day numbers and data points. When you take a step back and you talk about the expectations changing pretty rapidly here over the past month or so, I mean, what's the big picture here? Why is this happening? Why are things not picking up like so many economists were expecting?
Well, you know, I think going through the end of last year and at the start of this year, there were still people holding out for the V-shaped recovery. We had a nice GDP pop in the fourth quarter of 5.6%, and I think a lot of people were hoping we'd get a more normal recovery, which would mean 6% numbers for about 6 to 8 quarters in a row to really help us dig ourselves out of our hole. There were always people looking for that W cycle, but they were in the background. And if you look at the data over the last month, we've knocked the first estimate from the first quarter from a number with a 3 handle down to 2.7, and most market estimates for the second quarter were 3-something, as well as in the third quarter. Most economists now have a 2 handle, and in fact, our number has been knocked down to 2% in the second quarter. So it looks like we're not only seeing a subpar expansion, that it's actually pretty anemic and probably not fast enough to allow a turn in the unemployment rate. That the unemployment rate, though, has ticked down some this year, may not be trending lower if we can keep these economic numbers in such low growth territory.
Mike, I'm curious how you reconcile some of the economic data that we've gotten with earnings from companies like Intel that say that enterprise spending, for example, is picking back up.
Well, you know, when you look at earnings for corporations, it's a lot like savings for households. People have been looking at the savings rate, saying, you know, households are saving money. They're not spending it. The savings rate's rising. That means that they're pulling back on spending, and it's a negative effect for the economy. It sounds good that people are saving money, but if they're not spending it, we're not going to see the multiplier effects ripple through the economy. The same is true with corporations. Businesses are not reinvesting. They're not expanding fixed investment at the normal pace. In particular, it's the commercial construction market. Non-residential construction is continuing to fall. Normally at this point in the cycle, it's turning and starting on its way up. People just don't want to commit to long-term projects. They're hoarding cash, which is good for earnings but bad for the economy.
Well, but you know, in a case like Intel, the company did say that spending is picking back up, albeit from a very low level. Is that sort of the key here, that there might be an upward tick, but it's just that? It's not any kind of large trend?
Well, you know, that's an interesting point in its own right, and it's another dynamic to this global economy. The world economy is actually recovering quite well, and as Mike noted in his article or story about China, we're seeing a lot of very rapid gains in economic activity in Southeast Asia. Intel's a global company, and so we are finding our tech sector, many of the tech companies are actually doing well because they're riding the global bandwagon. Unfortunately, a lot of the weak data that we've seen over the last month has been U.S. factory sector data, where we were seeing somewhat of a boom, and we're starting to moderate now, and really it's all a reflection of weak aggregate demand. Real final sales in the U.S. economy has only grown at a 1.5% to 2% rate now for 5 straight quarters. That's a pretty slow growth rate for demand, even though our factory sectors have been somewhat rebuilding.
Mike, 10 seconds, double dip?
No, but we do think we're going to have disappointing data for the next couple of months.
Okay.
Hopefully the housing sector bounces from there.
Mike, we got to go. Mike Englund, Action Economics will be